AI panic is creating massive short squeeze setups in software stocks. While software stocks have been under pressure in recent months, as AI has shifted from being a perceived tailwind to a growing source of disruption risk, the latest leg lower was catalyzed by the rollout of a new legal focused automation tool from Anthropic's Claude large language model, LLM. The plugin, designed to operate as an agent across legal, sales, marketing, and data analysis workflows, highlights how frontier AI models are rapidly moving beyond infrastructure and into the so-called application layer, territory traditionally dominated by enterprise software vendors. For retail traders, this narrative shift has landed in an environment already primed for exaggerated moves. Many mid-cap and small-cap software names entered the year with elevated short interest, thin liquidity relative to mega-cap peers, and large retail ownership bases. When fear-driven headlines hit, these stocks tend to gap lower quickly as momentum traders pile on and stop-loss levels are triggered. At the same time, social media platforms and trading forums have become rapid distribution channels for both bearish theses and contrarian oversold bounce setups. This creates a familiar feedback loop. Sharp sell-offs attract retail dip buyers hunting for mean reversion, while short sellers press their bets expecting further downside. If price stabilizes or rebounds even modestly, the presence of heavy short positioning can turn what begins as a routine bounce into an accelerated move as shorts rush to cover and retail traders chase upside momentum. Options activity plays a central role in this dynamic. Retail traders increasingly express bullish conviction through short-dated call options rather than outright share purchases. When call buying concentrates at specific strike prices, market makers hedge by purchasing the underlying stock, which can mechanically push prices higher. This gamma effect can amplify moves far beyond what fundamentals alone would justify, particularly in lower float software names. In that context, any positive headline, a solid earnings report, strong customer retention metrics, upbeat guidance, or even a credible rebuttal to AI disruption fears can become a catalyst. Stocks that have been heavily punished on narrative risk can flip from structural losers to crowded contrarian trades almost overnight in retail circles. The strategic threat posed by LLMs is often compared to Amazon's early expansion from books into adjacent markets, but retail traders tend to focus less on multi-year structural debates and more on near-term price action and positioning. The prevailing question becomes not who wins AI in 5 years, but is this stock oversold right now relative to how bad the news actually is? We are not yet at the point where AI agents will destroy software companies, especially given concerns around security, data ownership, and use, said Ben Berenger, head of technology research at Quilter Cheviot. Berenger added that more volatility is likely. He said, during times of volatility, people often shoot first and ask questions later. For retail traders, that volatility is often viewed less as a risk and more as an opportunity set. Extreme drawdowns, high short interest, rising options volume, and improving technical setups are the ingredients many look for when hunting potential short squeeze candidates. As a result, pockets of the battered software sector could see sudden, explosive rallies, driven primarily by positioning and flow, even as the broader debate over AI's long-term impact remains unresolved. Retail short squeeze and momentum watchlist checklist. Retail traders commonly scan for a cluster of these factors rather than relying on any single metric. Number 1, short interest percent of float. 15% plus, elevated. 25% plus, high. 40% plus, extreme, crowded short. Number 2, days to cover, short interest divided by average daily volume. 3 to 5 days, potential friction. 6 to 10 plus days, high squeeze risk. Number 3, float size. Under 50 million shares, more volatile. Under 25 million shares, easier to squeeze. Number 4, recent price action. Down 40 to 70% from recent highs. Signs of basing, higher lows, or reclaiming key moving averages. Number 5, options activity. Call volume greater than 2 to 3 times normal. Heavy near-dated calls at out-of-the-money strikes. Rising implied volatility. Number 6, borrow rate or cost to borrow. Rising or already elevated. Shorts under pressure. Number 7, catalyst calendar. upcoming earnings, investor day or product launch, analyst upgrade or target hike. Number 8, social sentiment, rapid rise in ticker mentions, shift from bearish to oversold bounce or short squeeze setup language. Number 9, liquidity profile, lower average daily dollar volume increases squeeze potential. Number 10, narrative shift, any evidence AI is additive rather than destructive, new wins, partnerships, AI-driven upsell. How retail traders often think about it. The more boxes a stock checks simultaneously, the greater the probability of a violent move. Importantly, squeezes are usually flow-driven, not thesis-driven. Price action and positioning matter more than long-term fundamentals in the short run.